risk statement. This presentation is for information purposes only and doesn't constitute investment advice nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. This presentation is not intended for solicitation purposes but only for use as general information. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. Risk of loss in trading, foreign exchange, futures, and equity markets can be substantial. You should therefore carefully consider whether such trading is suitable for you in the light of your financial condition. Past performance is not the indicative of the future results. Level 1 Fresh Students, Section 4. Main title is Candlesticks, and this is Lecture 2, where we will consider Dojis and some other types of candlesticks. Dojis. Another candlestick formation that traders tend to overreact to is whenever they see a doji. Remember, a doji is a candle where the opening and the closing prices are the same. All dojis are not created equal though. The location of the closing price can change the significance as well as the range between the high and low. Also, dojis at key locations hold much more significance. Standard dojis opening and closing prices are the same. Shadow length can vary. Long leg doji, very long upper and lower shadows indicates neutral candles with strong balanced opposite faces. Dragonfly dojis opening and closing prices are high of candle, possible reversal pattern after bearish move, like this. Longer lower shadow is more bullish. Gravestone doji opening and closing prices are at the low of the candle, possible reversal pattern after bullish move. Longer upper shadow is more bearish. Windows. Windows are same as gaps that we studied in previous lecture. Remember, a gap is when the market opening in the next session differs from where it previously closed. We will cover gaps in depth in later lessons as well, where we will study the five different types of the gaps in more details. Right now we are just covering the very basic required to help analyze candlestick formations only. You should be able to visualize the difference. Window examples. In the example, the window is between the high of the first bar and the low of the second bar. This is the gap. This is called window. A window is traditionally looked upon as a continuation pattern and should provide support for the continued up move. Examples. In the example to the right, the window is between the low of the first bar and the high of the second bar. So this difference is a clear gap visible. A window is traditionally looked upon as a continuation pattern and should provide resistance for the continued down. In the previous example, it was like this. a gap or window between two bullish candles. So that's why it was support for continued up move. Whereas in this slide, it's between two bearish candles. So this is for the continued down move indication. Next, basic candlestick charts. In the following section, we are first going to take a look at a few individual candlesticks with the traditional interpretations to see if we come to some conclusion based upon what we have learned in the last few lessons. We will then take a look at some classic multi-bar formations to see if we also come up with the same interpretation. Bullish belt hold line. A long bullish candle that opens on its low and closes near its high without creating a large shadow is called bullish belt hold line, whereas bearish belt hold line, a long bearish candle that opens on its high and closes near its low without creating a large shadow, is bearish belt hold line. In day-to-day examples, you can find bullish and bearish belt hold lines in the charts, which are mentioned here as well. Basic candlestick. Hammer. Small real body, either bullish or bearish, with a long lower shadow that is almost 2 times the height of the real body and little or no shadow. There might be sometimes a little shadow. Don't take it like exact 100% hammer shape, but generally it's like this. And it shows possible reversal signal after extended bearish move. Shooting star. It's reverse of that. Sometimes you have to memorize few things. So hammer and shooting star are reversal in shapes. Small real body, either bullish or bearish, with a long upper shadow and little or no shadow at the bottom, and it's possible reversal signal after extending bullish move. Some other traditional patterns. Shooting star, hammer, as we discussed. You can see the real examples of the chart. Like here you see the hammer and its reversal pattern, and you can see these are real charts that it forms, rather it gave a huge gap or window. Bearish harami, a large real body bullish candle followed by an inside small bearish candle, this one. Normally considered a bearish pattern after an uptrend or extended bullish move. Here you can see both have been added. If we add these both candles, as we studied in previous lectures using candlestick math, which is very important, so this will be shown. Hope those who have studied previous can do it easily. If not, they should watch that as well. This candlestick math is very important to understand all the shapes of the candles. Likewise, as we just discussed bearish harami, so you can see this is a continuous bullish move, and this candle, which is inside this candle and is bearish, this is bearish harami, and it's a reversal pattern, and this is again a real example of the chart. All the examples we'll be using are real examples. So it happens like this. Bullish harami. A large real body, bearish candle followed by an inside small bullish candle, normally considered a bullish pattern after an uptrend or extended bearish move. Just opposite what we saw in bearish harami. Dark cloud cover. A large real body, bullish candle followed by a bearish candle with a gap open higher than the bullish candle. This. That closes back down well inside the first bar real body. Like this. Normally considered a bearish reversal signal after an uptrend or extended bullish move. Using the candlestick math, we got a candle like this. Piercing pattern is very, very important. Piercing pattern, a large real body bearish candle followed by a bullish candle with a gap open lower than the bullish candle high that closes up at least 50% back into the first bar real body. So this is after candlestick math we get a candle like this, which is a piercing pattern. Can be 1 bar, 2 bar, 3 bars, but using candlestick math, when you will add these bars, so the highs are equal, lows are equal, and once you subtract this, it becomes a long shadow, making it a piercing pattern. Normally considered a bullish reversal signal after a down trend or extended bearish move. Bullish or bearish engulfing pattern. First candle has a small real body followed by a candle of opposite color, which is an outside bar. Whether it's shaped like this is bullish, and if it's like this, exact opposite, it's bearish engulfing. Normally these are considered reversal signals after extended moves in one direction. And remember, reversal patterns help a lot, as we will discuss in next lectures. Then evening star, a large real body bullish candle followed by a small body candle that gaps above the first bar. A third candle then closes back well within the body of the first candle. So if you add these, you will get like this. So this is a shooting star candle pattern, normally considered a major top reversal pattern. With a bullish candle, then the gap, another bullish candle, and then falling candle is reversed, making a huge wick, and which is very much helpful for reversal patterns in the formation of midterm tops. We could analyze patterns all day. The important thing is that with what you are now learning, you don't have to go through and memorize a bunch of patterns. You can use the high-low open-close relationship along with the concept of windows and candlestick math to start noticing key market signals. In a future lesson, you will also learn about concept of location to help reinforce and apply the pattern.